right, diving in today, and this one's really for those of you already knee-deep in Web3 and DeFi, right? We're getting granular.
Definitely.
Yeah. So we're dissecting the Oceanpoint Whitepaper from Blocksquare. They're tackling this challenge we keep bumping into.
Yeah.
Liquidity, specifically when we're talking tokenized real estate.
It's the age-old problem, isn't it? Real estate and liquidity never quite seem to get along, but I mean, that's what makes this so fascinating. We've got Blocksquare. They're really pushing the boundaries with these Blocksquare property tokens, the BSPTs, fractional ownership, opening up access, democratizing the whole space, all those buzzwords we love.
Right. The promise, the potential.
Exactly. But the reality is we still keep hitting that same wall, these BSPTs. They're not exactly zipping around like your favorite meme coin, are they? The markets are fragmented, liquidity's thin, and let's not forget the KYC hurdles. That's a whole other beast when you're trying to seamlessly integrate with the free-flowing world of DeFi.
Totally. So enter Oceanpoint. Their solution, their big play.
This is where it gets interesting.
Yeah, it's like, think of it as like a custom-built engine, a liquidity engine, specifically engineered for this Blocksquare ecosystem. And their core idea here, it's all about creating this unified space, a space where you've got stablecoins, the lifeblood of DeFi, right? Your DIs, your USDCs, alongside these BSPTs, and then all these DeFi protocols we're all familiar with, all playing nice together. And
they're doing it in a way that's really smart, not just ripping everything up and starting from scratch. They're building on what's already there, integrating, evolving.
Right. Building upon those foundations.
Exactly. You see, it's not just about brute forcing liquidity. It's about weaving it into the very fabric of the ecosystem. And that's where POINT comes in. This new token, it's the linchpin.
Point token.
Yeah.
And this is where it gets really interesting for those of us, and I know you're in this category, those of us who live and breathe this stuff. It's not about replacing BST, right? BST, that's Blocksquare's OG token, governance, utility, the whole shebang.
That's right. BST's got its own crucial role, and they're not messing with that. POINT's not here to stage a coup, it's here to collaborate.
It's like they're playing different positions on the same team.
Precisely. It's about synergy. POINT steps in as this liquidity aggregator, greasing the wheels, making it easier to swap between all these different assets. You want to move from stablecoins to BSPTs. POINT's your bridge. And, it's doing all of this without stepping on BST's toes. Governance, utility, all that stays put.
So that's the big picture. But let's break it down, right? Our goal today, especially for you listening who's already deep in this world, is to really pull apart Oceanpoint. See how this whole BST point dance actually works. How do they really bridge this gap, this notorious gap between real estate, which is traditionally so slow moving, and then DeFi, which is it's like the crypto equivalent of the Autobahn.
It's a fascinating challenge, and they've taken a really methodical approach. I mean, when you dive into the white paper, you see it's not some overnight thing. It's built on stages, learnings, iterations. It's like they started with a solid foundation and then kept building layer by layer.
Okay, so take us back then, before we even get to Point, right? What came before? What were those first building blocks that Oceanpoint is built upon?
So you got to go back to the governance pools. That was the genesis, so to speak. You had the main pool, which this is where SBST came in.
SBST, that's the governance token, right?
Exactly. So BST holders could stake their tokens, get SBST in return, and that gave them a direct say in how things were run. It was all about empowering the community, right? Giving them a voice, a stake in the future of the platform.
So early on, it was all about community participation, setting up that framework for decentralized decision-making.
Exactly. And then they took it a step further with the marketplace pools, the launchpad. This is where certified partners could pitch their ideas for new tokenized real estate marketplaces. And the community, using their SBST, they could vote back the projects they believed in. It was essentially crowdsourcing the license fees for these new marketplaces.
Interesting. So that was all about decentralizing access, making sure those marketplaces were actually aligned with what the community wanted.
Yeah, and it created this really neat feedback loop, right? The community had skin in the game, so they were invested in the success of these marketplaces.
Okay, so we've got the governance pools, establishing the ground rules, the community involvement. What comes next in this evolution?
So then we move into the asset pools. This is where things start to really tie into those real estate tokens, the BSPTs.
Right, because up until now, it's been mostly about BST and governance.
Yeah.
But the real magic has got to involve those actual property tokens.
Yeah, you hit the nail on the head. So you have three main types of asset pools: the issuer BSPT pool, the community BSPT pool, and the marketplace BSPT pools.
Okay, break those down for us. What was the thinking behind each one?
So the issuer BSPT pool, that was all about incentivizing property owners to actually tokenize their assets. They could stake a portion of their own BSPTs, and in return, they'd earn BST rewards. It was kind of a learn-to-earn approach, as they put in the white paper, encouraging those early adopters,
Smart. Get the ball rolling, reward those who are jumping in early.
Exactly. And then you have the community BSPT pool. This was open to anyone holding BSPTs, not just the issuers. They could stake their tokens, earn BST, and the rental revenue generated that went straight to the DAO treasury. And this is where we start to see those deflationary mechanics at play. The DAO could use those funds to buy back and burn BST, putting upward pressure on the price.
Okay, so that's interesting. So not only are they incentivizing people to hold BSPTs, but they're also using the rental income to benefit BST holders, right?
Right.
To increase the value of the existing token.
Right. They're tying those two pieces together, creating this positive feedback loop. And then lastly, you have the marketplace BSPT pools. These were specific to the properties listed on those certified partner marketplaces we talked about earlier. It gave those marketplaces another way to generate revenue and attract users. You could stake the BSPTs representing those properties and earn rewards. It was all about pushing that hold real estate, earn crypto narrative.
Okay, so with these asset pools, they're really starting to build out the real estate side of things, incentivizing tokenization, creating these yield-generating opportunities. But there's still a missing piece, right? The liquidity piece.
Yeah, you're right. Up to this point, they've tackled the governance side, the yield generation for the real estate tokens, but that ease of trading, that seamless flow of liquidity, it's still not quite there.
Right, and that's where traditional real estate really struggles, right? You're not exactly, day trading houses.
Exactly. And that's precisely the problem they set out to solve with the next evolution. Liquidity pools, specifically the BST ETH pair. This is where they really started bridging the Blocksquare ecosystem with the broader DeFi landscape.
So this is where we get into like the more familiar DeFi territory, AMMs, liquidity pools, all that good stuff.
Yeah. They launched this pool on Uniswap, allowing users to provide liquidity to that BST ETH pair. And then users could stake their LP tokens on Oceanpoint and earn even more BST rewards. So not only were they increasing the liquidity for BST, but they were also giving people a way to potentially offset impermanent loss.
Right, because impermanent loss, that's always the boogeyman when you're providing liquidity.
Exactly. And what I find really interesting is that these liquidity pools, they're designed to be perpetual. Unlike a lot of those DeFi liquidity mining programs that have a set time limit.
Right, those kind of flash in the pan liquidity events. This is meant to be ongoing.
Yeah, sustainable. They even talk about potentially sourcing future rewards from the actual cash flows generated by the real estate assets themselves. And they're also looking at expanding these pools to other pairs like BST USDC or even BST.Point down the line.
Okay, so we've got this whole history, right? Governance pools, asset pools, liquidity pools for BST. It's like they were methodically setting the stage, laying the groundwork. And now we finally get to the heart of it, the liquidity challenge for tokenized real estate. And I think it's important to really unpack this, right? Because anyone who's dabbled in this space knows that liquidity it's the Achilles heel.
It's the elephant in the room, the hurdle everyone's trying to jump over. And the white paper, it really lays it out, doesn't it? The core problem. Fragmentation. You've got all these individual BSPTs, each one representing its own little slice of the real estate pie. And each one has a relatively small market cap.
Right. You're not talking about, Bitcoin level market caps here.
Not even close. And that means low liquidity, right? High spreads, lots of slippage. It's just plain expensive and inefficient to move in and out of these specific BSPTs. And then you layer on top of that the whole KYC requirement. Now, I get it. KYC is important, especially in this space. But it adds friction. It's not exactly the seamless experience that a lot of DeFi users are accustomed to.
Yeah, you go from like this permissionless world of DeFi to suddenly having to, jump through all these hoops.
It creates a barrier to entry. And then you contrast that with stablecoins. Stablecoins, they're the darlings of DeFi, right? Deep liquidity, easy to trade. But they don't offer that that direct exposure to real estate appreciation. And then you've got those existing tokenized real estate marketplaces. They're innovating, but even they struggle to provide that truly deep, seamless trading experience that we really need to see mass adoption.
Okay, so that's the problem statement. We've got this incredible asset class, real estate, being brought on chain, but it's not quite clicking with the DeFi machine.
And that's the puzzle Oceanpoint is trying to solve, isn't it? How do you connect those two worlds in a way that's both secure and efficient?
Right. So bring us to the solution. How does Point, this liquidity aggregator, how does it actually work?
So at its core, Point is a pretty straightforward ERC20 token, uncapped supply, which is an interesting choice. And the way they're minting it initially, it's tied to specific stablecoins, primarily DAI, USDC, and USDT. You deposit those stablecoins, you get Point at a 1.1 ratio.
Okay, so it's very much playing in that stablecoin sandbox in those early stages.
Exactly. And they've said they eventually want to allow minting through the deposit of eligible BSPTs as well.
Yeah.
But that's further down the line. For now, it's all about those stablecoins. And of course, you can always burn your Point to redeem the underlying collateral. That 1.1 redeemability, that's really key. It's what positions Pointy as that bridge, that connector between those less liquid BSPTs and the hyper liquid world of DeFi.
So it's like initially it's very much functioning as a stablecoin, right? But there's these hints, these whispers in the white paper about Point potentially becoming something more. This whole flatcoin-like characteristic. What's going on there?
Yeah, that's where things get really interesting. It's like they have this grander vision for Point. It's not just about being a stablecoin gateway. It's about evolving into something that reflects the inherent value of the underlying real estate. So while it starts with that direct 1.1 stablecoin peg, the idea is as Oceanpoint matures, they'll start to diversify the collateral backing Point. You'll have stablecoins, sure, but you'll also have a growing portion of those BSPTs in the mix.
Okay, so it starts to shift away from just being pegged to the dollar to being pegged to a basket of assets, a basket that includes real estate.
Exactly, and that's where the whole flatcoin concept comes in. They're not just trying to mirror the US dollar, they're aiming for something more like purchasing power stability that's tied to the value of real estate, which, historically has been seen as a good hedge against inflation.
So it's kind of like a hybrid, right? It has that stablecoin stability in the early days, but then it potentially evolves into something that reflects the broader real estate market.
Right. And that transition, that's going to be fascinating to watch. How do they manage that shift? How do they ensure that peg, that stability, as they bring in these less liquid, harder to value assets?
Yeah, that's a whole other conversation. But sticking with this idea of stability and backing, the white paper also talks about over-collateralization. What role does that play in all of this?
So over-collateralization, that's a key part of their risk mitigation strategy. In the beginning, when you're minting Point with stablecoins, it's that straight 1.1 ratio. But as the protocol grows, as they accumulate more collateral, both stablecoins and those BSPTs, the system can become over-collateralized.
Meaning the value of the collateral is greater than the circulating supply of Point.
Exactly. And that excess collateral, that creates a buffer. It provides a safety net in case of market volatility. And the white paper even suggests that if this over-collateralization persists, if they build up a substantial surplus, they could adjust that 1.1 redemption ratio.
So potentially Point holders could redeem their tokens for slightly more than they initially put in.
Yeah, it's like a way to distribute some of that protocol success back to the Point holders. It rewards them for their early participation, for taking on that initial risk.
Interesting. So it's not just about stability, it's also about potentially sharing some of the upside. Now let's shift gears a bit. We've talked a lot about Point, but what about BST? Where does the OG token, the governance token, where does it fit into this whole Oceanpoint picture?
Yeah, it's crucial to understand that BST, it still plays a vital role. It's the backbone of the entire Blocksquare ecosystem. It's what governs everything. Pointy is like the facilitator, the lubricant, but BST, it's the steering wheel, the engine.
Okay, so they're very much designed to work together, to complement each other.
Right. BST holders, they still earn yields by contributing value to the protocol. You can stake BST, you can provide liquidity, you can actively participate in governance, all those things. And they benefit from the overall growth of the ecosystem. If Oceanpoint takes off, the value of BST should theoretically go up. And of course, they get those governance rights. They can vote on key parameters like the dynamic rate system, which we'll talk about in a minute, and the target portfolio composition, which determines the the ideal ratio of stablecoins to BSPTs in the protocol's treasury.
So BST is still very much about governance, utility, and capturing that long-term value of the ecosystem.
Exactly. And Point, it's all about that immediate liquidity. It's the fuel that keeps the engine running. And the beauty of it is those two things are interconnected. The more Point is used, the more liquidity it generates. The more activity there is within the ecosystem, the more BST benefits. You see, they actually created this virtuous cycle.
Okay, so it's not like they're competing with each other. It's more like a symbiotic relationship.
Exactly. And the white paper even specifically says that most swaps between BSPTs and stablecoins, they're likely going to be routed through a BST.point liquidity pool. So as Point gains traction, it actually reinforces the value of BST. It drives demand for staking, for governance participation, for all those things that make BST valuable.
It's like Point T is pouring fuel on the BST fire, so to speak.
Exactly. And it's a really smart design because it aligns the incentives of both token holders. They both benefit from the success of Oceanpoint.
Okay, so we've got the big picture, the token dynamics. Now let's talk about how they're actually rolling this thing out. The white paper outlines a multi-phase roadmap. And I'm curious, why take this kind of this gradual approach?
It's all about risk management and building things sustainably. DeFi moves fast, right? But you can't just, launch something this complex and expect it to work perfectly from day one. It's got to be iterative. So in Phase I, it's all about getting those core foundations in place. They're establishing that mint and burn mechanism for Point, using those key stablecoins, DAI, USDC, USDT. They're launching that BST.point liquidity pool on Uniswap V2, and they're incentivizing liquidity providers with BST rewards.
Okay, so Phase I, very much about laying the groundwork, getting that initial liquidity flowing.
Right. It's about proving the concept, getting those first users in, building some momentum. And then in Phase II, this is where they start to bring in the BSPTs, the real estate tokens finally enter the picture.
The main attraction.
Exactly. So in Phase II, you'll be able to deposit your BSPTs, get point exchange, or vice versa. But that 1.1 stablecoin redemption, that still stays in place. And this is also where they introduced the dynamic rate system, which is it's a pretty clever piece of engineering.
Dynamic rate system. Okay, explain that one. That sounds important.
So the dynamic rate system, it's all about maintaining the desired balance between BSPTs and stablecoins in the protocol's treasury. They have this target ratio, which the DAO initially sets at 20%. And the dynamic rate system, it uses NAV discounts and premiums, as well as those stablecoin deposit and withdrawal taxes to nudge the market towards that target.
Okay, so it's like a self-regulating mechanism. It automatically adjusts those incentives to keep those ratios in check.
Exactly. It's all about proactive risk management. And Phase II is also where we see the Oceanpoint router come in. That's another key piece of the puzzle. It's designed to simplify those multi-step swaps between BSPTs, PointCT, and stablecoins.
Making it as frictionless as possible.
Yep. It aggregates liquidity from multiple sources, finds the best prices, minimizes slippage, and they've built in all these security measures, to prevent price manipulation and front running. It's really well thought out.
Okay, so Phase II, it's about bringing those BSPTs into the fold, establishing those mechanisms for balanced collateralization, and really streamlining the user experience.
Right. And then in Phase III, they really ramp up the risk management side of things. That target BSPT ratio, it gets bumped up significantly to 80%. So they're really leaning into the real estate aspect of the protocol at this point. And the dynamic rate system, it gets even more sophisticated. Those discounts and premiums, they're adjusted based on whether the protocol's holdings are skewed towards real estate or stablecoins.
So it's constantly monitoring the market, making those micro adjustments to maintain that balance.
Right. And this is also when they introduce Point Zero. Think of it as like the ultimate safety net.
Point Zero. Okay, tell us about that one.
So if the collateralization ratio ever drops below a certain threshold, Point Zero kicks in. The protocol automatically releases stablecoins, buys back Point on the open market, and burns it. It's basically a way to artificially reduce the supply of Point and restore that desired collateralization level.
Okay, so it's like a circuit breaker. It steps in those emergency situations to prevent a full-blown meltdown.
Exactly. It's a really important safeguard, especially when you're dealing with an asset class like real estate, which can be, a little more volatile than your typical stablecoin.
Right. Okay, so Phase III, it's about It's about dialing up that BSPT exposure, adding those advanced risk management features. What about the final phase, phase 3? What's on the horizon?
Phase 4 is where things get really interesting. This is where they introduce BSPT lending. So you'll be able to use your BSPTs as collateral to borrow point T.
Ooh, so we're getting into like that leveraged DeFi territory.
Yeah. It opens up all sorts of possibilities. You can use it for leveraged trading strategies. You could even potentially set things up so that your rental yields automatically pay down your loans. Of course, there's also the risk of liquidations. If your collateral falls below a certain level, your BSPTs could be converted into point to cover the debt.
Right. So there's definitely more risk involved at this stage, but also potentially more reward.
Exactly. It's a high-risk, high-reward game. And it really underscores the importance of that BST governance. BST holders, they're the ones who'll be setting those interest rates, those liquidation rules. They're the ones who'll be ultimately responsible for ensuring the stability of the system.
So it's like this gradual progression, right? From stablecoin liquidity to full BSPT integration, advanced risk management, and then finally these more sophisticated DeFi functionalities. It's like they're building a whole financial ecosystem brick by brick.
And they're doing it in a way that's really transparent. The white paper, it goes into a lot of detail about the technical architecture, the smart contracts, the algorithms they're using. It's all there for anyone to see.
Yeah, and I know we have some pretty technically savvy listeners. So let's dive into that a bit. What are some of the key technical highlights that really stand out to you?
So for those who love getting under the hood, the white paper really lays it all out. You've got the core smart contracts, the Oceanpoint token, which is, your standard ERC20 token with those crucial mint and burn functions. And then you've got the Oceanpoint protocol contract, which handles all those deposit and withdrawal logic. And it's designed to be upgradable, which is important. It means they can roll out new features without having to, create a whole new system each time.
It's flexible. It can adapt as the protocol evolves.
Yeah, exactly. But the real star of the show, at least from a technical standpoint, it's got to be the Oceanpoint router, or OPR. That's the brains of the operation. It's what connects everything, makes those swaps happen seamlessly.
And it's not just doing simple swaps, right? It's actively searching for the best execution paths, taking into account all those different liquidity sources.
Right. It's not just connecting to one exchange or one liquidity pool. It's pulling from Oceanpoint itself, from 0x limit order books, from decentralized exchanges like Uniswap. It's constantly scanning the market, finding the best prices, minimizing slippage.
So it's like having a personal trader in your pocket, always working to get you the best deal.
Exactly. And on top of that, they've built in all these security features, slippage protection, so you're not getting, totally wrecked by unexpected price movements, Oracle-based price validation using Chainlink and Uniswap's 2app to prevent price manipulation, and they've even integrated MEV protection using flashbots to make sure you're not getting front run.
So it's secure, it's efficient, it's really impressive stuff.
It is. And the cool thing is they're not done yet. The white paper talks about future plans to integrate even more liquidity sources, to implement automated rebalancing strategies. They're constantly pushing the boundaries of what's possible.
Always innovating, always iterating. Okay, last but certainly not least, let's talk about risk management and governance. Those are absolutely critical in any DeFi protocol, especially one that's dealing with real-world assets.
Yeah, you can't just throw together a bunch of smart contracts and hope for the best. You got to have those guardrails in place, those mechanisms to mitigate risk. And that's something Blocksquare has clearly put a lot of thought into. Their philosophy, as they state in the white paper, is all about maintaining collateral stability and practicing responsible governance.
Okay, so break that down for us. How do they actually achieve that?
So that dynamic rate system we talked about, that's a big part of it. It's constantly working to incentivize that balanced composition of BSPTs and stablecoins within the treasury. And then you've got the potential for over-collateralization. If they build up that surplus of collateral, that provides an extra layer of protection. And if if things do start to go south, they have those under-collateralization mitigation strategies. They can increase spreads. They can adjust those NAV rates. They can manage those BSPT purchase discounts. All these things are designed to keep the protocol stable, even in turbulent market conditions.
So it's like a multi-layered approach to risk management. They've got those proactive measures in place, but they've also got those reactive measures, those circuit breakers, if you will, ready to kick in if things get hairy.
Right. They're not just crossing their fingers and hoping for the best. They've really thought through the potential risks, and they've built in those safeguards.
Okay, so to wrap things up for our listeners, the folks who are already fluent in DeFi, what are the key takeaways about Oceanpoint? What should they be paying attention to?
I think the biggest takeaway is that Oceanpoint has the potential to be a real game changer for tokenized real estate. They're tackling that liquidity problem head on, using this really innovative approach with the Point token. And the fact that it's all built on top of this established ecosystem with the BST governance token, with the community involvement, with those proven track records of the governance pools and the asset pools, that gives me a lot of confidence.
Yeah, it's not just some fly-by-night project. This is built on a solid foundation.
Exactly. And the team behind it, they're clearly very experienced. They're very thoughtful. The white paper is evidence of that. It's incredibly detailed. It's well researched. It's clear that they've really put in the work. So for someone like you who's already deep in this space, I think the key things to watch are how this dynamic rate system plays out, how effectively those risk management mechanisms work in practice, and how that whole Point token, how it evolves. Does it actually manage to achieve that flatcoin-like status? Does it become this bridge between the world of real estate and the world of DeFi? That's the big question.
It's a fascinating experiment.
Yeah.
It's really pushing the boundaries of what's possible in this space. And I think for our listeners, it's worth digging into that white paper, getting into those details, really understanding the mechanics of it all.
Yeah.
This could be a sign of things to come.
It could be the blueprint for the future of tokenized real estate. And I think, for anyone who's paying attention to this space, this is something you don't want to miss.
Absolutely. All right. Well, on that note, we're going to wrap things up here. Thanks for joining us on this deep dive.
It's been a pleasure.
And we'll catch you on the next one.